afternoon, everybody. Welcome back. It is getting late into the afternoon, and we made sure everybody who's interested in the coal mining industry sticks around, because we're finally going to talk about where the heck is the money going to come from. So we've heard big plans, and we've heard smaller plans, and we've heard significant challenges, and we've heard about spectacular opportunities. And the last time I checked, all of this needs to be funded. I mean, so where's the money going to come from? And we've put together a very good panel under the chairmanship of Henk de Hoop. Henk is currently Resources Sector Focus Lead, Corporate and Investment Banking at RMB. Now, Henk gave me a poll question to put to the audience. And you can see Henk is a banker. He wrote a thesis. I mean, a question really should be 3 words and a question mark. But let me put Henk's question to you as a poll question, and then we'll come back to that at the start of Q&A. So the poll question that you as the participant should partake in now is, should the South African financial sector actively drive or accelerate the energy transition away from coal by proactively closing the taps? Or should they rather simply follow? So your first option is, the South African financial sector should drive and accelerate the transition away from coal. In other words, starve us to death, I think is, if I were to write the question, I would have said, just starve us, close the taps. The second choice is carry on as usual and protect jobs. South Africa as a country has much bigger problems. So can we really afford to be closing the coal mining industry and starving it of funding? That's your second option. The third option is work together with the coal industry to help them finance a rational transition path. So starve the industry, carry on as usual, or collaborate with the industry to finance a rational transition path. We'll come back to that at the start of Q&A. Henk, over to you and your panel. Thank you very much.
Thanks, Bernard. Yeah, this session we're going to talk a bit about finance and also investors and investors' attitudes towards coal. So I probably want to start with Johann, because you're, as a company, you have invested recently through Seriti in a new set of coal mines. So there's something you see in coal that possibly some of the overseas investors have given up on. What does Thebe see in coal as a theme, as it being still worthwhile an investment?
Well, thanks, Henk, and good afternoon. But I guess I just should declare my bias here. I think last year some people complained because I had renewable energy projects on the one side of my background and coal projects on the other part of the background. So Thebe invests both in renewable and in coal, and in other energy related projects. So I think that's important to say, that we do view that energy is quite important, obviously, for South Africa's economy, and getting a balance, and for us, obviously, a balanced portfolio is quite important. So we still have a view that coal has a place, and we have a view that coal will definitely have a place post 2030. I think there's a lot of pressure, and 2030 is obviously a date that comes up more and more, but we do know that Medupi and Kusile will still be running well past that, if we think the initial plans are obviously either a 50-year life of power station or even a 60 year life of power station. So we see that the demand in South Africa will still be there. Although we have probably more than enough capacity to build wind and solar in this country, those build-outs are really constrained, I guess, by factors such as how fast government wants to see that rolling out in a planned fashion and what the funding is available behind those projects. So we will see that for some time in the future, there will be significant coal demand still in South Africa. And we even see that some forecasters are predicting that there will be a shortfall over the next decade. So we will see the demand still being there, and we will see prices obviously being supported by that. We see the overseas market as well, but I think we need to bear in mind here, and you probably discussed this today. A lot of our exports still go to the steel making sector and into the cement making sector, for which there really aren't alternatives at the moment. So we still see there's a future, and we still see as a commodity and investment horizon, we still see worthwhile for Thebe to invest in related projects. Thank you.
Thanks, Johann. I guess Thebe is a private investor and might not have the same pressures as some of the public investors. And Prince, that's maybe something I want to discuss with you. You basically invest on behalf of portfolio managers. Though, do you still see enough of a mandate to continue to invest in coal and coal opportunities? And particularly, we've seen a new company emerging on the exchange. What's your company's view? Do you feel the pressure already, or do you have an open-ended mandate for now?
Yes, thanks a lot, for having me on this platform. It's my first time here, and thanks also to the organizers. And to answer your question, Henk, yes, majority of our clients, mainly in the public equity space, do still allow us to invest in coal companies. A good example, as you've mentioned, of this is our recent investment in Thungela Resources, which recently listed on the JSE and the London Stock Exchange. And as guided by our investment philosophy, Thungela still demonstrates an attractive valuation, even after applying a punitive ESG discount to our free cash flow focus. And the ESG discount is applied above our calculated WACC, resulting in a much higher cost of capital overall. And I'm happy to say that we are currently reaping the benefits, because Thungela has rallied more than 70% since its listing, and we've managed to capture most of that upside for our clients. And overall, we believe there's still considerable upside from the current share price to our assessed intrinsic value. Now, to answer your second question on potential pressure or pressures we are currently seeing, locally, we haven't honestly seen much pressure from investors. However, we have seen a lot of ESG emphasis during DDs of late, where most of our existing and potential clients want to know about our approach to applying ESG factors in our assessment of risk and prospects of any company we plan to invest in their portfolios. Perhaps it's only a matter of time until we see much increased pressure, but I think we must also emphasize that platforms like this one give us confidence that the current higher price environment is likely to remain for longer, which will still likely result in higher returns for our clients. And I guess that will leave us all happy.
Okay, thanks, Prince. That sounds all still pretty positive. And now, John, I'm going to throw it to you. You've been involved in this conference for the last 2-3 years, and I think you're very connected with the international investor base, and obviously that mood has probably shifted a bit more radical than what we've so far seen in South Africa. What are you seeing as a sentiment change over the last 2 years, and where is it currently? Is coal and Thungela as an investment still investable from an offshore perspective, or is it now too tainted to touch?
I'm not sure it's changed much in the last 2 years. I mean, I would say even 2 years ago, it was pretty difficult, really, for a lot of investors. First of all, it's that the public funds, with the retail customer base or the pension funds, it's marketing to them, and the marketing's relatively simplistic. And that just tends to be, things are good or bad, and coal is just in the too difficult box for them to get involved in. And I think that was already set 2 years ago. I think there are relatively few areas that will still, a few hedge funds, retail, yes, they will, dabble in it, but the mainstream funds, by and large, it's quite difficult. And I think, you know, it was interesting, Prince talking about, you know, ESG discount. Is there a market there? Well, what's the price? And am I selling something, or am I almost giving it away? And if you're giving it away, then yeah, you can probably get people to hold it. Could you raise new money? I really don't think so, you know. And since I started doing, I think when I first did this conference, you know, Rio had just got rid of all of their coal. But in that time, since BHP, it's gone, Anglo's gone, Glencore's set a path. So the sort of, you know, the diversifieds have all moved out or set a very clear path to moving out. And institutional funding, I think, is definitely not there, you know. So, you know, Western banking or insurance for coal projects is pretty well impossible. So no, I think sort of Thungela shows that in a way. I think we'll see that through the flow back, and where the register ends up, it's just really, yeah, it's too difficult.
Yeah, so you're basically saying there's a very clear distinction between offshore investors and domestic investors, because there is that flow back and a shifting more towards the South African shareholders to possibly have not as many of the pressures, but also probably see the important picture of coal still needing to support the overall power sector. And maybe then
you've got a better informed. I think Prince has a more informed investor base in many ways. Understanding the complexities of the issues.
Understood. And Johann, when John was talking about the divestments happening, you've picked up under the Seriti, obviously, company, the South 32 assets. In sourcing funding for running the assets and acquiring the assets, have you experienced challenges, or did it go quite decent with the existing banking environment?
Yeah, thanks, Henk. I don't really want to speak too much for Seriti specifically, but we do see that there was support from the financial institutions that Seriti uses. So I think there probably are some gentlemen from Seriti. I've only been able to join now, so I'm not sure what they've said. But yes, obviously there's always challenges. But from what we can see, there was the transaction has proceeded, and there've been other transactions where we are able to achieve what we want to. We do see that although there's a lot of pressure on funders not necessarily being able to apply themselves to coal, I think we should be careful about how we categorize that. And I think most people probably on the conference are aware that that really applies to new, for a lot of funders, to new coal-fired power stations or similar. But we see that there is still support from most of the majors, actually, for trading and for coal mining. So we did see that support coming through. And then there's also, I mean, some of the other challenges are insurance costs are going up, but it's interesting. Even on the renewable energy side, we do see that those insurance costs. So we thought the coal industry was the only one taking significant pain. We do see pressure from those who back the large insurers as well. But we actually do see that even on the renewable sector, that insurance costs have increased significantly. But yes, and I think it's important to note that that IDC, I mean, someone like Reginald Dumana, who's got a lot of coal experience from Nedbank and from being at West Coal, I think we see someone like that heading up mining at the moment at IDC. I don't want to preach for them, but I mean, I would hope that you would see that IDC continues to support the sector as part of the mandate. Thanks.
Understood. Thanks. And Prince, I guess it will be a question of time that banks and insurance companies will be forced, either through shareholder pressure or through funding partnership pressure, have to throttle back on the industry. What what timeline are you thinking from an investment perspective, where you would say, okay, now it's getting too tough for this industry to continue operating with the constraints that are being imposed on that particular industry? Is that from here to 5 years, and then it's going to be very tough to operate, or do you see a longer term picture for the South African coal mining companies?
Thanks, Henk. We think at least 5 to 10 years, obviously with potential for this to extend further into the 10 to 15 years time frame, for instance. However, this we believe will highly depend on how fast the world is likely to transition into the other alternative energy sources, which I guess was at least one of the main debates today in this conference. And maybe just to add color on that, for instance, majority of some of the high emitting countries are targeting carbon neutrality at least by 2030, guided by the enhanced transparency framework of the Paris Agreement. And that is roughly about 10 years from now. However, that target could easily be stretched out depending on the overall progress made until then. And that's why I'm saying, it will highly depend on, how fast, we can deal with this energy transition into alternative energy sources.
Thanks,
so 5 to 10 years is probably where we are currently seeing the prospects, but obviously it might just as well stretch out.
I guess for any country so dependent on coal, making a transition of the scale required is a massive challenge, John. But the likely what could happen to South Africa if we take our time? We understand the pressure, but we have lots of workshops to see how we can do it properly, but actually don't move along on that path. What could happen to South Africa, you think, from an overseas investor or political pressure points? What are the risks for South Africa? We don't move along at a certain speed on this path.
I think it's a really difficult question, and I think relating to some of the previous questions on this theme, this is where sort of financial markets and government policy all get a little bit too overlapping, and who really is going to be able to drive that agenda. And it's particularly dangerous for me as an outsider to get involved, too involved in that. I mean, of course, it can continue. South Africa could continue as it is, but ultimately, then where does the funding come from for projects, and what are the political pressures and political influences that come with that? If it's, for example, particularly having to look more towards China for funding projects, what does that mean in terms of your cost of power? What does that mean in terms of your investment in infrastructure? I mean, we are now at a situation where renewable is effectively cheaper than coal. So, it's sort of in some ways not so much a financial market decision. The financial market will follow, but it's very much, I think, a government policy decision. But it's really difficult because, of course, coal is, as has already been mentioned, it's both a tremendous employer and a great dollar earner, and that's quite an addictive combination. Pretty hard to walk away from.
Yeah, understood. Johann, if you look also further ahead, and there would be continued, call it, liquidity draining from the coal sector, you as an indirect shareholder in the coal business, how does a large coal group like Seriti eventually find the sources of cash and to sustain itself? Who will step into that breach?
I think that it probably applies to a lot of entities in this who'd be in the same space. You would look at your traditional exporters with significant balance sheets. I mean, it's protecting their bread and butter to support the coal miners. I mean, and then, but you will obviously see some of them go down the value chain, but obviously there's direct support and indirect support. You would also see that while we as a country are transitioning, the many financial institutions that have exposure to ESKOM and to the country as a whole. So it's important that the support for ESKOM to continue running, and it can't run without funding, and it can't run without coal, not in the short term at least. But yes, there will be more pressure to look at alternatives. And then again, as I mentioned the IDC before, they will probably also still remain there as part of their mandate to support the industry in the country. And I think a lot of that comes with baseload energy. I'll probably be criticized for generalizing too much as an alternative for heavy industry at the moment. And I would hope to see that they'll still be part of that sector. And then, of course, you see contract mining as well. I mean, it's a large portion of contract mining is open cast coal mining, even in underground mining, where that's their bread and butter as well. So you'll still see a lot of indirect, it's not funding, but it's indirect support coming from that sector, in my view. Thank you.
Yeah, thanks, Johann. And to Prince, as a portfolio investor, there's already certain funds that have, say, restrictions on alcohol, smoking, gambling. Is there a likelihood that coal will eventually?
Yeah, Henk, look, unfortunately, we believe there's that possibility of coal being blacklisted eventually, even though in the near term, like I've already mentioned, we are likely to see continued support from some investors like ourselves. However, and perhaps speaking to the theme of this very same conference, we believe coal-fired power generation remains critical for the future, and our opportunity to limiting potential blacklisting lie within possible technological advancements that will come with a low carbon impact in general. And as per the Paris Agreement, this speaks to the vision of fully realizing technology development and transfer for both improving resilience to climate change and reducing GHG emissions. And overall, we believe this will be done to ensure that we produce relatively safe and environmentally friendly coal-related products along the entire global coal value chain. Because my understanding is that, you know, I don't want to sound bullish. I'm a mining engineer by profession. It doesn't seem like, you know, the issue here lies with the product, but rather, you know, it lies with the final product. In essence, what I'm trying to maybe say is that we need to have a collaborative effort in ensuring that along the value chain, we find, you know, each other in ensuring that, you know, we limit, you know, carbon emission in total, as opposed to it being focused from perhaps one sector, for instance.
Okay, thanks, Prince. John, we mentioned it earlier already that the South African investors seem to have a bit more appreciation for the context of where coal mining sits, the challenges that South Africa has, and call it the S in the ESG. And in your conversations with investors, and you already said, look, 2 years ago they're already out, but is there any softening or understanding that it's not necessarily a one size fits all policy in getting out of coal at the same speed or even at an accelerated speed because of the social context and the issues and the challenges a country has? Is there one big brush and basically coal is bad and you better hurry up? Where does South Africa fit in that perspective?
Look, I think there there is understanding, but there's a difference between understanding and acceptance. And I'm not in any way saying that's right, but I think that's that's sort of the way it is. There's a really, I think, a really interesting example a couple of years ago. Kosovo, small republic, came out of Yugoslavia and the former Soviet Union, largely dependent upon coal and very old Soviet thermal power stations. Had a plan to build a new power station. Would have probably been the single largest environmental cleanup in Europe. 90% dust emissions. This is a plant that causes significant illness within the republic. Couldn't get funding. I mean, it was a, it just, so there was sympathy, but there wasn't really any appetite for it. And I think part of the problem is that these are complex issues. And I think one of the weaknesses of the sort of Western investor is they have simplistic behaviors reacting to complex issues. And so, so coal is bad, and you go, yes, but, and it doesn't really deal with that. And I think the companies are partly responsible for this. And I've sort of said this at this conference before, the companies need to be much, much better at talking about the issues, talking about them realistically, and recognizing and developing the complexity of those issues. So, and I'm this may be unpopular, but Anglo talked about that they'd long had a recognition of the importance of transition. They talked about that in their releases when they were doing Thungela. Well, that's not transition, that's disposal. That's turning it into somebody else's problem. And by and large, I think that the companies have to develop the narrative, be a lot clearer on what the issues are, have a more what's relevant to the places where they're operating, what's relevant to them as companies, and the ESG dialogue has got to be led by them, and a much more realistic one. And until that happens, I think the whole thing ends up a little bit box ticking and simplistic. And so the majors dispose of their coal. Coal mines haven't gone away. They're still there. They're still operating. They're still having an impact on the environment. But I can sleep okay at night because my money's not invested in them. Doesn't really make the world a better place at all. And that dialogue's got to be a more intelligent one going forwards.
Thanks, John. And I guess, Johann, you've been catching some of these assets that have been disposed of, and already the overseas investors have said, look, that's not for us. South African investors not yet there. I guess the banking industry is already under pressure. Nedbank has already made their announcements. There will be a day when sources of funding will properly dry up. Who are the last man standing then to support the industry? Is that the traders? Is that the IDC? Is that keeping lots of cash on the balance sheet to finance your business? What will be the end game?
I think you've answered that, and I think it will evolve as we go along. But I would obviously the traders are only going to support part of your business. Back many years ago, we obviously saw cost plus mines, where ESKOM also supported mining, and I think there was through the cost plus mines. And so there was also another alternative form of funding. But with an ESKOM contract, it's always been very possible to raise capital. So some sort of a hybrid maybe going forward, while there is still a need to keep maybe Medupi, Kusile, one or two other power stations going in order to support the economy. Obviously, solutions have to be found. If we cannot... or we haven't got sufficient renewable energy yet, I mean, we absolutely have to keep the economy going. And so traders will probably always play a significant role there because of the size of their balance sheet and understanding the market. It's a lot, probably easier for them to deploy their capital as they understand what they're getting into, rather than trying to convince a funder, to fund. I mean, a funder always wants an overhang, especially for mining, of at least 50% in terms of its life of the loan facility. So, I mean, to effectively amortize capital for coal mining capex, you probably want more than 8 years. So we're looking at 12-year, them wanting to see a 12-year horizon. And I think as the traditional funders battle more and more to see that horizon, willing to support that horizon, we may see traditional funding drying up, yes, and being supported more like traders, and some sort of a solution with ESKOM where they're able to raise capital. Yeah, thank you.
Thanks, Johann. I see, Bernard, you've appeared in my window. Presumed time is up. There might be some questions.
Thank you. Don't go away, Henk. We can now, move you from being the person who puts the questions to one of those damn bankers who wouldn't fund our industry, So we can put you on the spot for the rest.
I was hoping to avoid that.
So the poll that we put to the audience is a very small percentage. 12% of people think that the financial sector should be driving and accelerating the transition. 18% says carry on as usual and protect the jobs. And not surprisingly, 71% opted for the sort of like collaborative approach, work together with the coal industry to help them finance a rational transition path. But Henk, one wonders whether the banks will really be able to be good corporate South African citizens, or whether they would just, and let's talk about fund managers and banks, financiers. Would they be able to do that, or would they just simply have to take the easy way out and join the green wave and make these empty announcements? I mean, realistically, can the banks do what's in the best interest of South Africa in this case? Or are they also worried about their own shareholders and taking a slightly narrower, self-interested sort of view? What would you think, Henk?
I guess no. It's a very fair question, and I guess the pressures are from different directions for banks. It's the shareholders who basically said that we need to be seeing you doing something about your carbon exposure. So if you don't do anything and you ignore it, we basically divest. There's pressures from rating agencies that look at the overall risk profile for a bank, and they see this red blob in the portfolio nowadays, and they see that as a risk. So what are you doing about it? And there are conversations around that. There's obviously a lot of public and NGO pressure on banks as well, like do your bit, why aren't you doing your bit? So the pressure is coming from all sides, but at the same time, we and most of the South African banks are hugely exposed to South Africa. So you can't move in a way that would, for example, risk the electricity supply to 90% of your clients. It has to be in a sensible way. But at the same time, the conversations we are having with clients are moving much more heavier on ESG and what are their own plans. And as long as companies have a plan, I think there is always a sensible discussion around funding. But if you as a company ignore it completely and do not, and if you're not working on some plan to transition, reduce your own emissions in producing the coal, it's going to get tougher, because we've seen a radical shift in the type of conversations and pressures we've been put under over the last 12 to 18 months. And probably was globally anyway, the whole COVID debate and the renewed start of the world economy. And I guess we're all seeing the headlines now on the disasters, heat waves, and what have you. So this is becoming a very, very strong debate inside all the banks and how to work together with the industry on a path forward.
John, I mean, and I think you started joining our conversation to help us elevate the broader ESG conversation. And is the ESG conversation going to, in time, make us all do what we can do, as opposed to finding the straw man or the scapegoat of coal mining in South Africa, to really make an extreme point. I mean, I'm pretty sure Jamie Dimon and JP Morgan sort of flying all over the world to meet with each other. It's got a huge impact, but nobody is yet asking them to mitigate that. I mean, for the moment, we can stop funding. JP Morgan can stop funding coal mining in South Africa. I mean, it's a bit of a false sort of narrative. And surely ESG is going to change the narrative to be more complete. Surely we're going to address impact on climate where we see it, where we can, not the rich north deciding for the poor south what is. Or am I too parochial in my view, or is the conversation actually going to get more real as ESG evolves?
I'd like to think so. But I think what you're telling me, you sense a whiff of hypocrisy around it. It
smells, and I think it smells of carbon. It smells of. It really smells. I mean, doesn't it?
No, I think that's fair. I think that's a really fair criticism, and it's a lot easier to get somebody else to sort out their problems than to sort out your own. And that's an imbalance, isn't it, in where the sources of capital are. I mean, we shouldn't forget, of course, that one of the biggest leaders in the whole ESG debate is effectively a carbon fund from Norway. I mean,
yeah, exactly.
I mean, when you start off on that basis, it's a difficult journey to go down. So no, I think that's but as I was saying earlier, I think the problem is the conversations are terribly just too simplistic, and the companies need to take control and be a lot better at explaining it and leading the narrative. But the companies go for the simplistic.
Prince, I want you and Johann to help me unpack this Thungela thing, partly because I was so wrong. I mean, I thought that if your shareholders tell you to get out of something, you don't give them the shares in return. I thought that when Goldfields spun out Sibanye, initially, the very shareholders who didn't want those shares dumped it, the share price halved. So I was going to buy Thungela at 12 Rands a share, not at 42 Rands a share. So I'm irritated that I missed this sort of boat. But what are we missing here? I mean, so why did these shareholders, who supposedly told Anglo to get rid of these assets, then gladly receive the shares? I mean, is this just pure? I mean, was this driven by advisors? Or I really am struggling with the sort of, and I'm sure by now a few of those shareholders that really were anti it have sold. But that overhang, if Anglo was really acting under shareholder demand, there should have been a huge sell-off. So what am I missing?
I think, Prince, let's leave it to you. Yeah.
Johann, well nominated. Yeah, no, I mean, let Prince just make enemies of Anglo. Yeah.
No, look, if I may start, I think if you are looking at it from our point of view, we are guided by our philosophy, if anything, and that's what we sell to our clients as well. I mean, our philosophy is simply intrinsic value, which we believe is a pragmatic philosophy that understands that not all businesses are created equal, and there are higher quality businesses that deserve to trade at a premium, and there are lower quality businesses that deserve to trade at a discount. This philosophy, therefore, provides us that flexibility to invest in both businesses, by the way. However, we only invest where our bottom-up research gives us confidence that the fundamentals are better than what the market believes, and where there is considerable upside from the share price to our assessment of intrinsic value. Like I was speaking to Henk earlier on, our reason to invest in Thungela was simply because of the attractiveness it offered us, even after applying what you may deem as punitive discounts to our future free cash flows. Perhaps one can argue that it's because of the current higher price environment, but who are we to go against the trend to say that, the current pricing environment is likely going to fall if funding is kind of, if the industry is starved of capital, for instance. And in turn, what that does is it creates even more opportunities for remaining investors from a shareholder return point of view, because capital starvation leads to less expansions, which if demand remains sustainable, it would mean higher prices for longer, higher shareholder returns, and in essence, for those of us who are still believers, and also the industry at large, from which I was born from as a mining engineer, would still benefit. So that's what you are missing, Bernard, is looking at the noise called ESG, as opposed to you looking at the fundamental business itself and what it offers given the current market conditions.
Yeah, these young mining engineers are now insulting the old mining engineers. So you have very effectively not answered my question. So it is going to come to you on, but I just want to quickly follow up on the question. If I do a whatever weighted average cost of capital, or I apply a discount rate, let's just say in mining, a South African one is 15%, just to have a benchmark. How much higher would you make that to cater for this sort of ESG noise and factors? So would you use 16%? Would you use 20%? So what is the premium or the additional discount you would apply, crudely? Just to give me a sense for how do you go about this? Prince,
look, I must declare,
that was a question to Prince. He can't get out of all of the questions. I'm coming back to you in a sec, Johann, for the other question. Prince, so you introduced the sort of the discount, additional discount. Just give me a sense. What is it?
Yeah, look, Bernard, to be fair, our weighted average cost of capital, because Thungela literally has no debt, was about 15%, right?
Yes,
and
of course.
Once we ran our ESG model, we came with about 20% discount, ESG discount, because we were highly punitive. And obviously we have to be highly punitive because of the level of strictness we're getting from our client. So all in all, if you think about it, we had about 35% discount to our earnings. So you can clearly see that even after such a hefty discount, you are still getting this decent upside. Like I mentioned, maybe it's because of the current higher prices, which we don't, obviously forecast, into perpetuity, but obviously in the near term, the high free cash yields and the dividend yields you can't just ignore that in the short term, to be quite honest.
Yeah, I thought you said 15 went to 20. Then I heard you say 15 went to 35 by an additional 20. That's a mind-blowing additional discount. Johann, to wrap up the conversation and to sort of explore this space. So Prince talks about a dividend yield. One of the reasons I was surprised at this sort of getting rid of your so-called problematic assets through a public listing was it basically assumes future access to capital, but it ties you into dividend yield. Now, the alternative was to have cash generative assets that make more money than what they need in future and create real value. So, I mean, I think Henk said that, the funding will be a hybrid of lots of things, including cash on the balance sheet. I mean, at over $100 a ton, I mean, Thungela doesn't need to raise money. Thungela could fund themselves, for a long time, especially if they don't pay dividends to Prince and others. I mean, if they just really mine for profit. So just talk to me about the self-funding again. I mean, if a project is viable, why does it need outsourced funding? What model are we applying here to coal mining?
I think it's always, you always get a better return by using someone else's money if the cost of capital is obviously competitive with your cost. So you're still going to want to see any investor, even if it's the shareholder, wanting to leverage off of that and improve that return. I mean, there are many examples as well that it's always maybe that's not the reason, but it's always good to have the funders involved. I mean, they ask you a lot of the tough questions that shareholders don't ask themselves often. So you get an extra pair of eyes, an extra pair of due diligence. And then I suppose you get their support, which might support you in other ways. As Henk put it, I mean, you're not going to see the funders running away from ESKOM because it's fundamental to the economy, where all of our local banks have big exposure. You're not going to see them wanting to see ESKOM starved of coal overnight either. So it's really a circular. So I think it's very important. And we would always, I think any investor is going to want to see themselves leveraging other people's capital as far as they can.
So just briefly, was it the right decision for Thungela to be public, or should it have been spun off privately?
For me personally, we were quite overjoyed by seeing Thungela because it's a really interesting test case. And I think we're watching it very keenly to see where it goes. I mean, it's a really interesting example. And I think people will write textbooks about, or chapters at least, about this for a while.
Excellent. Listen, I wish we had more time. Thank you so much, Henk, panel. Thank you for being back. You will be back again. We will explore this. We will next year this time tell each other, I told you so. We'll find reasons to poke fun at Henk because that's what we do for a living. And he keeps on coming back, you know. So despite this abusive relationship, both John and Henk keep on coming back. Guys, thank you very much. We are breaking for a short tea break, but what an interesting and entertaining conversation. Thanks, gentlemen.
Thank you.
Thank you.
Cheers, everybody. Cheers.